Bloomberg Audio Studios. Podcasts, radio, news.
The worry with the UK, especially at the moment, is that investors have just lost faith in the UK as a place to put their assets.
Is Rachel Reeves facing a crisis of faith? That's the view of one investor, fund manager Eva Sun-Wai at M&G after the market turmoil that's hammered the pound and sent government borrowing costs soaring. Hello, you're listening to Bloomberg UK Politics. I'm Stephen Carroll.
And I'm Lizzy Burden. Today we're going to be bringing you a special extended edition of UK Politics because...
Dun, dun, dun.
Yet again, we find ourselves at a moment when politicians need to pay attention to what's happening on the bond markets. The government's borrowing costs have shot up this week as long-simmering worries over the UK economy appear to have hit a nerve with investors. Now, Stephen, there's global context here. Bonds have been selling off elsewhere as well, but the UK does seem to have been hit harder than other places. Maybe then a more important signal, as we'll get to in a moment, is the weakening in the pound. And I've said it before, I will say it again, markets are the guardrails on democracy.
We need a sound effect for every time that you say that, Lizzy. Look, the speed of the moves has drawn comparison to the Liz Truss mini-budget in 2022. This isn't the same situation, but higher borrowing costs are a big concern at a time when the government's borrowing more. The Chancellor's already had to raise taxes to try and make up for some of that. This is a story that's drawing in the worlds of finance, politics and economics, our specialty, I like to think. Let's take a listen to some of what's being said about the situation this morning.
What we are seeing in the UK is a train wreck in slow motion. The pound is getting hammered as well. So this is about the markets passing a no confidence motion against the UK every single day.
It's unnerving this morning, at least, to see that this market move yesterday has not calmed down. Now, many are drawing lines to the Truss era UK gilt blow up. Some are saying that we're not yet there. A tail risk of a UK having another gilt blow up is definitely looking like it's growing in magnitude.
The problem the UK has, which is a high level of debt, which is no longer very cheap to finance like it was in the 2010s, and a really weak outlook for economic growth. And that combination is going to be difficult for whoever is Chancellor.
It is normal for the price and yields of gilts to vary when there are wider movements in global financial markets, including in response to economic data. This is in stark contrast to the negligent, shameful horror of a circus performance that the Conservative Party unleashed on this country when they were in government a few years ago.
That was Chief Secretary to the Treasury, Darren Jones, speaking in Parliament this morning about the moves we've seen on markets. Before him, you heard the Institute for Fiscal Studies Chief Economist, Carl Emerson, and our colleagues covering markets here at Bloomberg, Valerie Teitel and Ven Ram.
Well, so now we've brought together some more of our top Bloomberg colleagues to cover the markets, the economics and the politics at play here. We're joined by our Managing Editor for Foreign Exchange and Rates, Rachel Evans, our UK Government Reporter, Joe Mays, and our Chief UK Economist, Dan Hanson. Welcome to you all.
We're like our own version of the Avengers. They're all here.
Rachel, I want to start with you. There's been this long string of superlatives that we could apply to the market moves over the past week. Do you want to just put into context what's happened on UK markets, but particularly for government bonds and for the pound?
Yeah, so I mean, this all really kicked off earlier this week as everybody was kind of returning from sort of the New Year and Christmas holidays. We saw long-term debt costs, those on 30-year bonds, rise to the highest since 1998. And this was kind of, sort of around the same time as we had the auction of 30-year debt, which was the UK's sort of first bond sale of the year. And it seemed to kind of be this catalyst that then got investors thinking once more about kind of the debt sustainability issues that the UK faces and kind of the fiscal burden that's really being kind of pushed to bond investors with all of the debt that the UK government is asking them to take down this year in order to fund their spending plans. So very quickly, this kind of escalated. We saw sort of 10-year gilts, the yield on those rose past 2008 levels. We've seen the pound falling. It's now the weakest since November 2023. So the superlatives keep kind of coming thick and fast. But it's really this kind of backdrop of just, how much the government wants to borrow and can they find investors who are willing to take it down? Not at any level, it would seem.
Can I just say, on days like this, it's an absolute nightmare because I get alerts every time someone says burden. And my notifications are going crazy. But look, you heard Darren Jones there completely denying that this was anything like the Liz Truss mini-budget moment. Is that fair?
It's certainly not there yet. We are obviously seeing some very interesting sort of size and scopes in terms of these moves, right? You know, we're back at 1998 levels on the 30-year.
Good year for pop music.
Very good year for
not
pop
good year
music.
for the bond markets.
Not a great year for the bond markets, and we were at that point in a very different environment. You know, then back in 1998, we had a very low debt burden, and we were starting to kind of bring down interest rates from I think as high as 8%. So different situation than now. But yeah, I mean, like when we do get these sort of big superlatives coming through, it does beg the question of whether we're heading into a new trust type crisis. But the thing that seems to be different at the moment is that this is part of a bigger kind of global reassessment of borrowing costs. UK is, whilst perhaps the epicenter and the one that's getting the most hammered by these concerns for a variety of factors, we are seeing this happening globally as well. You know, US yields are rising. We saw 20-year debt yields there rise past 5% for the first time in a couple of years yesterday. So this is part of a broader picture, and obviously there's a few different factors lurking behind, not least the incoming Trump administration and just what that is going to mean for inflationary pressures and the continuance of debt supply globally that bond investors are being asked to buy.
Okay, so this is something that is a moment within a larger context as well. Let's think about the politics next and go to our UK government reporter Joe Mays. Joe, what are MPs and ministers saying about this? How worried are they about how high the UK government's borrowing costs have risen?
Yeah, we just heard Darren Jones in the House of Commons trying to put on a kind of reassuring tone about how, they say market movements happen all the time and government doesn't want to comment on them. I mean, there's a brave face being put on it publicly, but clearly there is alarm within the Treasury about what's happening here and why it might mean that Rachel Reeves does have to announce perhaps spending cuts sooner rather than later to try and fix the UK's fiscal position and, give something to the bond markets to show that they do really care about fiscal credibility, fiscal responsibility. That's where the doubt has arisen, right? The doubt has arisen around the size of the borrowing plans that Rachel Reeves announced at the budget, how little headroom she gave herself against the main fiscal rules. So I think that's where the Treasury and the Labour Party are sitting at the moment. I think there's some surprise for backbench Labour MPs who perhaps didn't think we were in the realm of having to go for spending cuts after that fairly bullish budget from the Chancellor last year. So I think everyone's really coming to terms with this and it's kind of hitting people as a bit of a surprise moment, I think.
So Dan, for anyone whose eyes glaze over at the mention of yields and gilts and the bond market, just explain for us why we should care. What effect do higher borrowing costs have on the public finances? How much worse is the picture now compared to back on Monday?
So, I mean, just to think about it in really simple terms, the government, we as UK taxpayers pay tax and the government spends money, and there's a big gap between those two things at the moment, and it's what the government borrows or the fiscal deficit. And what the government does, it goes out to financial markets, and the financial markets finance that gap for the government. And financial markets ask for a price of that debt. There is a price for borrowing money. There's a price of money, and that's the yield. That's the interest rate on the government debt. And as Rachel and Stephen and you, Lizzy, have all said, it's been rising lately, and that is troubling for Rachel Reeves because obviously investors are demanding this premium, they're demanding this interest rate, and the government has to pay them. And that is one of the lines of spending that goes into the fiscal maths. So we're in a situation now where Rachel Reeves, as Joe just said there, she left herself in the budget a pretty small amount of what we call headroom, so that's sort of space against her fiscal target. Gilt yields have risen enough to wipe that headroom out now. So there is a question sort of looking ahead to March the 26th, which was meant to just be a forecast update. Rachel Reeves has said that she only wants one event each year where taxes and spending change. It now looks like she's going to have to do something, whether that's on spending or on tax. We can debate that, and that's why this move is so significant. And it's also, if you like, it becomes a bit self-fulfilling, doesn't it? Because as interest rates rise, the fiscal position becomes more untenable, and so you get this feedback loop and this concern amongst investors.
Rachel, how do we becalm them now after what's happened over the past few days? So we've heard a bit about the problem. I suppose if we think about what does Rachel Reeves need to say or do that's going to restore some sort of order?
I think it's very difficult for this to kind of come from the policy maker side because, I mean, there's only so much that they can really say without showing their hand or ultimately just sort of, not telling the truth about what's going to happen. Like, we know how much the government is looking to borrow this fiscal year. That is not likely to change. So, does she want to come out and say how they're going to fill kind of the gap and how they're going to take the pressure off the bond market by, increasing tax revenue or reducing, spending going forward? Probably not. So that's a pretty big ask. We have seen, some of the Treasury officials coming out to sort of make soothing noises about kind of how this is, relatively normal. And indeed, we're not seeing sort of some of the liquidity issues yet, anyway, that we saw back in 2022. That's a definite difference between now and back then. A lot of the sort of structural weaknesses that we had in the gilt market around pension funds, how they access liquidity, the infamous LDIs, those are now very much not really around. So we don't have those issues again. If we were to see liquidity issues come back to the fore, though, that's the sort of time we might start thinking about whether the central bank needs to intervene. They have a few different options for doing that, whether they have facilities to lend into the market to help ease liquidity, whether they directly buy gilts, whether they pause their QT program. These could all be on the table potentially, but we're a long way from having a liquidity crisis that would prompt such intervention.
Well, Dan, let's break down that QT point. Quantitative tightening. Why is that making this situation worse?
So during the financial crisis and during the pandemic, the Bank of England bought an enormous number of gilts, £895 billion worth, which is an enormous amount. And they're now selling those back to the market. And there are two bits of, and that's what we call quantitative tightening. So the selling back of gilts to private investors is the idea of quantitative tightening, and there are two bits of it. So the first bit of it is the Bank of England actively selling to the market, and that's the bit that really is the bit that sort of spooks investors a little bit. Though what I would say this year is that the bank is doing a lot less active quantitative tightening than it has in past years. It's only going to sell back £13 billion worth of debt to the market, and the reason for that is because there is a lot of debt that is maturing. So it's reached the end of its life. The debt is maturing, and that money is going back to private bondholders. So there are two bits of it, and sort of going to what Rachel was saying there about what the bank could do. The idea of stopping QT, the sort of marginal impact of not selling £13 billion worth of gilts to the market would be pretty minimal, to be honest with you, and I just don't think it's something that they would reach for. I also think Rachel's absolutely right that if you're thinking about where the intervention or what needs to be done to sort this out, where that comes from, it doesn't feel like it sits at the Bank of England's door at the moment, because that would be about financial stability. What we're talking about here is fiscal, a fiscal issue, and that speaks to what we said earlier about potentially tax rises, potentially spending cuts. And
it's important to kind of rule that out as not being a potential solution to this problem either. Let's go back to Joe Mays for I suppose a thought around the political side of this. As you've been reporting, the Chancellor, leaning towards spending cuts to try and address this. But how difficult are the political choices now facing her? Dan Hanson there, indicating that spending cuts may not go far enough.
Yeah, very difficult. I mean, even at the budget, Rachel Reeves, Keir Starmer had a pretty significant backlash from within their own cabinet, objecting to the spending plans even then. And so if we're saying that Rachel Reeves will have to come back and say, we're going to take even more money out of kind of the public spending envelope, that could be very difficult for her. And indeed, they'll have to do a lot of work to convince MPs and ministers that is necessary. I think that at the budget, we had spending plans of kind of 1.3% increases in public spending in 3, 4, 5 years' time. So those are very small numbers already. So they're kind of reducing from a low base, which makes it even more difficult. So, yeah, massive work Rachel Reeves will have to do to bring her party with her on this.
Joe, what's the difference between efficiency savings, spending cuts and austerity?
That's a very good question. I think that by and large, they are all of much of the muchness. I think that Darren Jones in the House of Commons just now was characterising austerity as an ideological approach where reduce public finances, reduce public spending with no concern for the effect on the UK citizens and public services. I think there's an argument that it's austerity really kind of more of an ideological pursuit. But we are very much in this realm of having to talk about where spending could be reduced and call it what we want. That's what this Labour Party, I think, has to deliver right now. And as we're saying that, given how the public spending plans are already quite tight, there might be some scepticism amongst markets if she goes for the public spending lever again, given how difficult that choice is, and therefore we might need to see some tax increases to really bring markets with them as well. So lots of difficult choices here for the Chancellor.
And you set us up beautifully to go back to our guests here in studio as well. Dan Hanson, I mean, you've done some calculations on this in terms of what the fiscal headroom looks like now with borrowing costs higher than they were at the start of the week. What have you found, and what does that tell you in terms of the policy prescription?
Yeah, so as I think I said earlier, that the £9.9 billion worth of headroom that Reeves set aside in the budget, that has gone. We think the increase in gilt yields since the October budget, so it's not just the most recent move. You have to take account of what the OBR assumed in its forecast and work out sort of if it did its forecast today, what would it say debt interest spending would be? And we think it would be £12 billion higher. So essentially she'd be a little over £2 billion offside. Obviously chancellors have historically always left headroom against their fiscal targets. £9.9 billion is a very small amount historically.
Well, she'd say it's more than the Tories left.
She would, and I'd say it's a lot less than chancellors have left historically. You'd have somewhere between 25 and 30 billion pounds normally to sort of give yourself a buffer against shocks exactly like this. This is exactly why you put that headroom aside. It's because you can see out these sort of gyrations, not only in markets but also in the economy. Stephen, on your question about how she will respond or how she could respond to this, I think Joe made a really, and I think it's the most important point around this, around spending cuts and the credibility of going down that route. It seems very unlikely she'll raise taxes to me just because of what's happened with the employer national insurance contributions. Obviously in the manifesto, income tax rises, employee national insurance, value-added tax, VAT, corporation tax, rises in those are all ruled out. So you've ruled out 70-odd% of the tax base, and there's obviously been this huge backlash against what she'd done in the budget. So then you go to departmental spending. I mean, you could cut investment spending. That's another option. But obviously you're a government going for growth, so that's completely inconsistent. You can cut departmental spending, but we already know, as Joe's just said there, that it's extremely tight. So cutting it even further, you'd have this fiscal fiction argument coming back at you. So that leaves the benefits bill. And that is obviously extremely politically difficult, but it sort of feels to me like if you're thinking about credibility, there's sort of the political constraints you're dealing with, and obviously benefits would be very difficult, but the market constraints you're dealing with, maybe the benefits bill would be something that the markets would believe more in if you went for that, rather than going, say, for, as seems to be the case, day-to-day government spending, which is already looks like it's on a path that can't be delivered. It's just the spending plans are too tight.
Rachel, would you agree with that? Is that going to be what's needed to shift investor perceptions?
I think Dan makes a really good point that it needs to have credibility, and to what degree the market buys kind of those different options, I think remains to be seen. I think the other thing that's kind of hard to sort of factor into this is just the ability of the market to sort of decide that it's found a solution and move on. If there is enough kind of said by the government that indicates we're going in the direction of finding a solution of some sort, then other stories come along. Things move on. We still have kind of a Trump inauguration later this month. So to me, in many ways, the thing that actually ultimately stops kind of this meltdown may not necessarily be a solution provided by the UK government, given that there are very few out there. It's very hard to see a silver bullet. The best that they can kind of hope for is sort of stemming the tide and kind of trying to reassure people in the short term and hoping the market moves on, which sort of historically, it does tend to. There's a relatively short attention span for the markets on these things. And I think, it's worth looking at sort of the situation in France as a sort of interesting kind of recent comparison. We did see, yields, particularly spreads of French debt to their German equivalents blowing out around some of the political upheaval there. But once it's kind of gone through that process, it has tended to then stabilise.
It's a Gallic shrug.
Albeit at those higher levels, right? When they're not going
very
away.
High Gallic shrug.
Yes, exactly. They're not going away. It's not like, there's nothing to see here, but it's not like something that kind of gets continually worse and worse. And given that we have seen markets already come a very long way, we've seen gilts moving up, gilt yields moving up successively over the recent days, that may be ultimately what kind of puts a floor under this, that they've come a long way. There starts to be bargains to look at. People start to think, actually, I can buy it at these levels, and the attention span of the market moves on to something else.
Yeah, I just want to bring you, given that point, and that, as you say, the markets can be fickle and capricious, and move on to something else very quickly. I just want to think about something perhaps a bit more underlying in the perspective for the UK economy and the jobs market. We spoke earlier to the Recruitment and Employment Confederation CEO Neil Carberry, and he talked to us a bit about how businesses are perceiving the situation at the moment, given that they did such a kind of a concerted effort to engage with business before the election. He says they now need to listen.
I think there has to be a real opening up on the next year to 18 months. What are you asking of business? And I think being willing to take some of the tough messages about, frankly, if I talk to my members around the country and they talk to their clients, what they're saying is right now we just don't have the confidence to move. They need some big signals quickly, and that has to come from the centre of government.
So that's Neil Carberry from the Recruitment and Employment Confederation. Joe, I want to go back to you because this is, goes back to the politics of it. Labour did such a kind of job of winning over business before the election. That message has turned very sour. That's a warning there from the labour market, if you will. I mean, how does Rachel Reeves marry that with the very harsh fiscal reality?
Yeah, I mean, one of the big criticisms that Rachel Reeves has faced post-budget is that, she talked about she wants to be a governor of growth, and yet one of the biggest policies at that budget was an increase in the national insurance payroll tax, which was a direct hit to business and was very much seen as an anti-growth measure. So I think Reeves knows that she is under pressure to change that narrative, bring a bit more positivity and optimism to her kind of economic narrative. And indeed, she's planning a growth speech after her China trip where she's going to try and make that case. I think that what I find so interesting now is that there will come a moment potentially in the Treasury in the coming days where they might have to think, well, we cannot wait until March 26th to address what's happening on markets. I think Rachel makes a great point about how, other things could come to the rescue, but other things could not as well. I think that's why we're a really fascinating political moment where Reeves might have to do something. But we'll have to see how it plays out on markets.
Well, Rachel's made the point that, in a sense, Rachel Reeves is at the mercy of global markets. Rachel, let me ask you, what is the next catalyst that we should be looking out for that could make gilt yields climb? We've got the US jobs report tomorrow. Could that spark another spike?
Yes, to be clear, yes. And we're certainly seeing that being mentioned in an analyst notes at the moment. I mean, if we're thinking about kind of how sort of the US sort of picture plays out, that there is the potential for, the Fed to need to cut more than the BOE, and therefore that could prompt a rally in US yields that leaves the UK lagging behind and standing out. And I think that decoupling, if we do see yields elsewhere stabilise or start to move lower, would be a very concerning sign for the UK. But beyond that, it's really kind of, sort of the incoming Trump administration that is putting the emphasis back on fiscal, a situation on inflationary pressures. And to Joe's point, that may be something that basically keeps the UK's problems front and centre, because they are really kind of sort of this lightning rod for some of those issues for investors.
Dan, on a scale of 1 to panicked, where are you today?
Because, Dan doesn't panic.
No, but he's very good at his dose of realism. So I feel like that, if we take away the excitement and the froth of what's happening on markets, what is your mood music for the situation? If we're looking at some form of fiscal statement, potentially at least an update from the OBR in March.
Oh, that's a good question. I don't know, maybe a 5 or a 6.
I told you.
But most days I'm a 1 or a 2. So it is. No, I mean, I think. Look, it's definitely a moment. Of course it is. But is it? is at the moment the sort of the comparisons to 1976, the comparisons to Truss. I just don't feel, I definitely don't feel like I did at the end of 2022. I can tell you that. I can tell you that right now. And so much of that is about the speed and the scale of the change in the move that happened at that time. It's just nothing like that. It's very, stealing a lot of what Rachel has said, but very globally driven. It begs the question how much the spending cuts or whatever gets announced can really do for the UK, because so much of it is to do with the Fed and what the Fed might do. I mean, Lizzy, you asked Rachel about, what are we looking for in the sort of weeks and months ahead for another catalyst. I think a really important moment will be the Bank of England decision on February the 6th, because there's so much there. If this sticks, what is the bank going to say? Will they say this is an unwarranted tightening of financial conditions? Will they cut? We think they probably will. The markets still aren't completely convinced of that, but it's probably more likely than not in market pricing. The OBR will then, if nothing emergency on the emergency fiscal side comes out, if the OBR then takes the yield curve after the Bank of England, or is likely to take the yield curve after the Bank of England meets. So if you've had a shift in yields then, maybe the headroom isn't gone. Maybe it isn't quite as bad as we all expect. And I think underpinning all of this is if the data, the data will be the guide to a lot of this, particularly out of the US, but also in the UK. And, we've got inflation data coming. Actually, on that front, the things probably look a little bit worse for the Bank of England, unfortunately.
Dan, you ended on a sour note. I was so hoping for a note of optimism. Our chief UK economist, Dan Hanson, thank you very much for joining us, along with our managing editor for foreign exchange and rates, Rachel Evans, and our UK government reporter, Joe Mays. That's it from us for today. If you like the programme, don't forget to subscribe. Give it 5 stars so other people can find it on Apple Podcasts, Spotify, or wherever you listen.
This episode was produced by James Woolcock, and our audio engineer was Sean Guastamakia. I'm Lizzy Burden.
And I'm Stephen Carroll. We'll be back with more on Monday. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.